Welcome to the latest quarterly review update from Beaufort Investment. I'm here with Shane Balkham, Head of Portfolio Construction. Shane, welcome. Let me start by asking, how did things go last quarter?
Thank you, Brian. We finally got some action from the rhetoric of Trump's trade wars talk, and it ended up being 200 billions worth of tariffs being applied to China at a 10% rate, going up to 25% in January. That seems to have unsettled the markets a little bit. It's got this sort of perfect storm between protectionism and rising interest rates, with Jerome Powell still going ahead with 3 rates this year, with an extra one looks like it's going to be on the cards.
And how has all of that affected the portfolios?
Portfolios did well. As you know, we're making the portfolios more defensive, so we're not expecting to capture every bit of market upward movements because we're looking to protect on the downside. But they've held their course. All the portfolios providing a positive return over the period, which was really pleasing.
Looking forward, how are you positioning the portfolios for the next quarter?
We're looking at different asset classes. Something like emerging markets is becoming a little bit more attractive to us. It's been the victim of a strong dollar, which traditionally happens in these circumstances. So the valuation for emerging markets is looking very attractive to us at the moment. So we've got our analyst doing a lot of work on that. Japan is one of our high conviction areas, so we're looking to add Japan before the end of the year. Asset class wise, it's about making sure we have a diversified portfolio geographically within equities, but within different asset classes as well, so bonds and equities. And as you know, we're already making it more defensive than it was, say, 12 months ago. So if there is a correction, we should expect to hold up better than the marketplace.
At home, news that Mark Carney has agreed to stay on longer. How do you think that's going to affect the economy and the markets?
From our point of view, I think it's great news. Mark Carney's agreed for an extra tenure of another year, so he's going to be here till mid-2020. That's in addition to the previous year he made this time last year. It gives the UK economy continuity in the event of whatever the Brexit result ends up being, whether it's a deal or a no deal. We've got a consistent head of our central bank. In the same way Japan increased their term for Kuroda, giving him an extra year. We've seen what a change of central bank can do. Jerome Powell came in this year with the US, and it has generated more uncertainty. The ECB next year, they're going to have a change at their central bank, and we expect that to generate uncertainty. So to have Mark Carney at the head for another 2 years, I think can only be good news.
So in the US, the Fed talking about rate increases much more and quicker than they were originally. How do you think that's going to affect over there and then impact on us and globally?
Well, that's a good question. I think what we see with the US, and Jerome Powell came out and said, they said follow the dots. Now every committee meeting they have, each committee member puts a dot where it expects how many rate rises to have. And traditionally that's been very good forward guidance. You haven't fought the Fed on that, you knew exactly where rates were going to go. What the market doesn't understand at the moment is, will Jerome Powell still plough ahead irrespective of the data, or will he curb if the data becomes a bit weaker? Now, the markets are expecting 4 rate rises this year. We've had 3. We expect a fourth one in December. Next year, it's a little bit uncertain. Now, we've had a really good reading for unemployment in the US, and growth in the US has been analysed at 4.2%. Now, these were above expectation, which the market has taken as bad news, ironically, because that might mean the central bank rises more aggressively, whereas the markets would like a bit more of an accommodative Federal Reserve because it's been used to 10 years of accommodative, easy monetary policy. So we're in this sort of ironic situation where good news is bad for the markets, and bad news, so weaker data, the market would take in a good stance.
We've got many clients in income portfolios. They don't solely rely on that income, but obviously they do expect a certain level of income. Do you think with the uncertainty and Brexit on the horizon, that could impact on their dividends, their returns?
Good question. I mean, for income clients, it's more about the yield they're receiving rather than the underlying value of their portfolio. And over the last 12 months, we've focused very hard to make sure that both income portfolios are generating a good level of return. The FTSE is generating just over 4%, and our sustainable income funds about 4.65%, and our high income is over 5%, giving that extra yield, but a little bit more risk over what's sustainable. Going forward, you're going to see fixed interest generate a little bit more yield, cash generate a little bit more yield, and we don't think equity will reduce their dividend payments as well. People are looking for that safety because yield is hard to come by. So if people can avoid looking at the underlying capital value for the medium term, I think they won't be disappointed with the yields they're going to receive as income in the short term.
Shane, thank you again. Excellent update for the clients. Look forward to hearing from you next quarter.
Thank you, Brian.